So what I want to do is now reference my cap stack to get my full undrawn amount. And now I need to create a formula for my drawdown. The whole idea here is I don't want to draw down upon my revolver because it is very expensive debt. SOFR plus 100 would be equivalent to 6.3%, unless I'm in a cash deficit. So unless this line is a negative number. So how I'm going to do this is I'm going to say if our cash available is in a deficit or less than 0, I'm going to take the minimum of our available revolver, so the undrawn minus the beginning of period, or the amount that needs to be paid down, our deficit. From there, I'm going to multiply it by -1 to return a negative number, and that is satisfying our first part of the equation or possible scenario. If we don't have enough cash to pay down, we need to utilize a revolver. Now on the other side, we want to see if if that cash is positive and we have cash available, we want to start repaying this, or we want it to return 0. So the whole idea here is going to take a min function. So the minimum of our beginning period balance or our cash available, and then I'm going to multiply that by -1, and that is how much we are paying back, right? So our end of period balance is 0 in this case. Come in, write this, check to see if this is accurate. Yes, wonderful. Now from there, we can test this out. Let's say that the cash available is negative, we don't have any cash and we're in a cash deficit of $1 million. I'm going to need to draw down upon my revolver $1 million, resulting in an end of period balance of $24 million, which flows back to the next period's top, right? And here it's saying that, okay, I now have 118 million of cash to pay down, therefore I'm going to pay down my revolver. However, that is not the case. So now that we have our drawdown / paydown equation, we now want to calculate our interest expense, the amount undrawn, as well as the commitment fee on this amount that is undrawn that we have to pay for holding a credit facility, $425 million of a credit facility. So the whole idea is, first I'm actually going to move this over here. Excellent. So the whole idea here is my calendar year ends in December. However, this company's fiscal year ends in July, so middle of the year. Therefore, we need to take an average of the previous year and the current period. So I'm going to take the average of our end of period balance, and we're going to go over to the cash flow statement, borrowings from line of credit, come back to our debt waterfall, and then we want to multiply this times our interest expense. However, we need to divide that, convert it from into bips, so divide by 10,000, and then add our period SOFR. We also want to fix this, and and we should have it there. 690, wonderful. Now moving forward, right, this isn't going to be our equation moving forward because we don't want to pull from the cash flow statement. We actually want to pull from the previous period here and take that average. I just did it, pull it from the cash flow statement in this statement, and in this case because I had Q1 starting off here opposed to fiscal year 23. So I'll write this here, but what I want to do is take this, delete it, and just have it reference this. Excellent. Now for the undrawn amount, it's rather simple. All I'm going to take is the full amount, and then I'm going to subtract the end of period amount in the revolver. Forgot to fix it. There we go. And then for my commitment fee, the price I have to pay for having this debt facility open, I'm going to take the fee and multiply it by the amount that I have undrawn, and fix this. And I believe that should do it for our revolver. We can play around with this a little bit and see really how it works. You get the idea. So yeah, that's how we model out a revolver. Excellent. After finishing the revolver, we want to get into the term loan. So the term loan has some similar properties to the revolver, such as it is also based off of a SOFR spread. However, there are a few things that you want to keep in mind when dealing with the term loan. The first one is the company has the ability to pay down the term loan at any point in time with no penalty. Oftentimes, if they have excess cash, they'll be able to allocate this towards paying the term loan itself. And the second is term loans will often, we have it in this scenario, will often have a mandatory principal payment per period. And in this case, we can see that they have to pay 2.4 million quarterly installments on their principal. So the whole point is, if I am a company and I have excess cash, it's a good idea to pay this down so I won't incur greater interest costs on that principal in the future. So the first thing we'll do is we'll do our beginning period balance. And then we want to get into our that mandatory payment slash amortization feature. And then I'll also mention or insert the cash sweep here, which we'll talk a little bit about later. I kind of mentioned earlier how they have the ability to pay down. This is referred to as a cash sweep. And then we have our end of period balance and our interest expense. Excellent. So let's come over and look at the rate, $2.4 million per quarter. So we'll put that right here. And we'll denote it here. Excellent. And then our interest expense is going to be this number here. Excellent. And we'll even copy the formatting from this as well. Excellent. We also want to incorporate the maturity date in column D so we can calculate it later, or so we can figure out when we want to incorporate it into the full payment. So let's set this up so we know that our beginning period is going to be equal to our end of period from the previous period. And for our end of period balance, we want to use end of 2023, and that we can see that the end of period for 2023 for the term loan was 220,832,000. So 220,832. Excellent. Now let's get into our mandatory payment / amortization. So we have to, again, create a formula, and the whole idea is what I want to do is, one, take into account the full due date at which I pay down my entire payment or my entire debt instrument, or I want to take into account my mandatory payment that I have to pay off. So how we're going to do this, we're going to do an if statement. So if the maturity date for this instrument, we'll fix this as well, is less than the corresponding period's date, then we're going to take our beginning of period balance and multiply it by -1. So that's one side. On the other, we want to take, if this is not, the maturity date, then we take the minimum of our mandatory payment, we're going to lock this as well, and the full beginning of period balance. Then we'll multiply this by -1 as well, and close it out, and that should give us this number here. So let's get into our cash sweep. The whole idea here is we need to create a formula that allows us to state that, hey, if me as Napa has extra cash lying around, I may want to pay down this term loan so I can avoid future interest payments. So how I'm going to do this is I'm going to take the minimum of the remaining balance, so my beginning of period balance plus my mandatory payment, and the cash I have available for repayment here. Multiply that by -1. Now, it is also possible the company doesn't want to actually repay this full amount because they want to possibly allocate cash in other ways, or they want to just have more cash on your balance sheet, right? So what I want to do is say, hey, it's possible that I don't want to do this. Let's create some sort of button here. So what I'm going to do is have a cash sweep button or toggle over here. Let's do 1. And now what I'm going to do is multiply this by my toggle, and I'm going to lock that in place. Now let's say as a company I don't want to pay down my full term loan. Do this and now your cash sweep isn't taken into account. So from there, now we can get our end of period balance. We'll turn our toggle to 0 at the moment. Our end of period balance of $211 million. Check that these formulas are all fixed here. Excellent. And there is our term loan. We can see that here we are repaying it in at this date because our formula is taking into account full repayment. For our interest payment, we're going to do the same thing we did above, where we're going to take our average of these two, average of end of period, and multiply it by our plus our spread. We have to divide that by 10,000 to convert the units, plus our given SOFR. Let's fix this. And there we have it. Let's finish this up, clean it up, make it look more presentable, and then we'll go over circular references, how we avoid circular references, and how this debt waterfall will create a circular reference, and how we create a circuit breaker for it, and the reasoning behind it. So first, let's multiply all these by -1. And then why don't we make this look a little bit better? Change this to C. Excellent. You can make that into a toggle as well. Like it down here better, honestly. Meh. We'll move it up. Excellent. And just make sure this is all referencing. Now when we think about it, we want to make sure there's no circular references. However, with this cash sweep, or sorry, with this debt waterfall, it's nearly impossible not to have one. And I will give you a little demonstration why. Alright, so now that we have things cleaned up, let's get into how to avoid a circular reference. So the reason why we're going to have a circular reference here is because what's going to happen is we are saying that there's this much current period cash flows, and this revolver is going to utilize that cash to pay down this excess, or to pay down this extra debt within our cash sweep, therefore leading to Excel bugging out regarding especially regarding how we get to a number on our end of period cash. And the whole idea here is I'm going to have a total interest expense that's going to be inserted into our income statement under our interest expense, and then this is going to flow down to our net income, which will naturally go to our cash flow statement and then draw down here, but we are referencing the amount of cash we have here, along with our long-term debt, leading to our end of period cash, which flows to our balance sheet, onto a revolving line of credit, as well as our long-term debt. So the whole idea is we need to somehow amend this. So what we're going to do is I'm going to alter our debt waterfall a little bit to help lead us so it makes it a little bit easier, and we don't have to, with the term loan, we don't have to code for circular references. And the whole idea here is I'm going to need what we call a circuit breaker. So a circuit breaker basically sets our interest to 0, which gives us the availability, or gives us the opportunity to reset the entire model and undo this circular reference. So what I'm going to do is I'm going to take all of this, I'm going to bring it down to here. I'll do one more. And then I'm going to have some sort of what we're going to refer to as a circuit breaker. Before we do that, one thing I want to get into is we have this equation here that is referencing our cash flow statement. So this is our cash flow from operations, our cash flow from investing, and some of the cash flow from financing. What I'm going to do is actually alter this. It's a little hiccup here. I'm going to alter this and say, hey, I'm now going to have cash flow from operation cash flow from investing, and this gives us our cash available for mandatory debt repayment. And what we want to do here is equal, sorry, we're going to insert one more line here, and then we're going to scrap this formula. So if we delete this, it's going to alter throughout our throughout our cash flow statement because it's referencing this at the moment. We're going to need to change that reference. So how this is going to work, let's get our cash flow from operations for 2024. Cash flow from investing. And what we're going to do, excuse me, sorry, we're going to take this and we're going to end up deleting this in a second. But what we're going to do here is we're going to take the sum of our beginning of period cash, our cash from operations, and cash from investing. And this number gives us what we have available for our pay down. So let's keep moving forward here. Next, what we want to do here is input our mandatory pay down. So our mandatory pay down is just going to be equivalent to our repayment of long-term debt. And then we take this over here and we say this gives us our cash available for discretionary pay down. Excellent. So now let's just command write this. And the whole idea here is what we want to do is alter our line items that are referencing our cash needed to pay down, or for pay down or drawdown, and put it available for discretionary pay down or cash available for mandatory debt repayment. So the issue with this here, I went over it a little bit earlier, is this is including cash flow without a revolver, which also includes our long-term debt, which creates another circular reference when we want to put in our repayment of long-term debt. So what we need to do here is we are going to take these equations, and then instead of referencing this here, we're going to be referencing this. So now let's alter these equations. So I'm going to come here and say this is going to reference our cash for discretionary pay down. And we're going to command write that. And then I believe this is the other equation here, our cash sweep that is referencing this. And we want to put this also cash available for discretionary pay down. And command right there. So now what we want to do is get rid of these line items. This isn't how you typically build it. I just made a little error earlier where I was including certain line items I didn't want to do. So let's say I just delete this. This has no effect on my below revolver or my term loan, and I'm just also going to delete this. Delete that row, delete this row, and now we're set up in a much better place. Now we can tinker around with this a little bit before we get into building this. We see everything is still working. Flowing through correctly. But now we need to create what we like to call a circuit breaker. So a circuit breaker allows me to reset my model, because if right now if I go and come over to my income statement and input my interest expense and I don't want to do this because it will break my model, so make sure you don't do this without creating a circuit breaker first. What you want to do is have a circuit breaker function which will allow us, we'll use an if function, I'll show you how to do that. But if I just take this number here, it'll fully break my model because it's referencing itself, therefore giving us a value or ref error. So we don't want to do that. What we need to do is build our circuit breaker. So what I'm going to have this do is I'll do on and off. So the whole point of a circuit breaker is what's going to happen is it allows me to reset my model, to set my circular reference to 0, therefore erasing the circular reference. So the whole idea is with every single line item that I may think will have a circular reference, including on my interest or including on my income statement, my balance sheet, and my cash flow statement, I want to connect back to my circuit breaker. So my first step is I'm going to create a button here. So Alt-AVV, any value I want to go to list, and my source is going to be here to here. So now I want my circuit breaker on or I want it off. You get the point. But what I need to do is incorporate this into my equation. So what I'm going to end up doing here is I'm going to say, and we'll do a hypothetical here, say this is my interest expense line item on my balance on my income statement. What I'm going to do is I'm going to say if my circuit breaker is equal to on, then I want it to be 0. If not, I'm going to reference my total interest expense. So the whole idea here is if it's off, it'll give me this number, and say I screw up and rough out my entire model, I get to set it back to 0, and it'll fix it when I turn it back on. Because oftentimes with a circular reference, it won't just affect this cell. It'll flow throughout the entire model, creating massive problems that you have to get back down to the original circular reference, which is a pain in the ass. So now let's start inserting our functions with a circuit breaker. So what I want to do is come over to my income statement, and actually what I'm going to do here is I'm going to name this as CB for circuit breaker. So now what I'm going to end up doing, I'll delete this. I'll come over to my income statement, and we have to notice that this is a sum, so if I put in a negative here, then this will grow and it won't be a negative because you're subtracting the you're subtracting the other expenses from your operating income. So what I'm going to do is if CB is equal to on, I want it to display as 0, but if not, I just want to make sure I was referencing the right cell. If our circuit breaker is equal to on, I want it to display 0. If not, I want it to give our total interest expense. We'll turn our circuit breaker off for now. And now, I'm not seeing any circular reference at the moment. One thing I should note as well is go to Alt-TO, down to formulas, and enable your iterative calculation. So your iterative calculation basically forces your formulas to go to 0. So it doesn't just give me a value or so if I turn off my enable iterative calculations, what's going to happen is it won't let me actually input this number here. It'll say there's a circular reference, and it'll give you a little error message, and you do not want that. So let's take a look at what happens when I turn my circuit breaker on. This goes to 0. Let's turn it back off. Change of scenery. I'm now down in Santa Barbara, so I'll be down here for a few days and we'll finish this thing up. Now what we want to do is we want to link our repayment of long-term debt to our cash flow statement. So we're going to go over to our cash flow statement and use that same circuit breaker function. So we see payments of long-term debt. So we're going to come here to the year and we're going to do if CB equals on, give me a 0, and if not, I'm going to go down to repayments of long-term debt, Control right, and then when looking at issuance of long-term debt, we don't believe they're going to be issuing any. They haven't guided it, whatsoever in our SEC filings, nor do I believe that they'll need to in the future. due to them having plenty of cash moving forward. We will deal with these quarters here momentarily, but let's get into our revolver now. So the whole idea is with the revolver, what we want to do is we're going to take this number here, right? We see there's both payments and borrowings. With that being said, what we want to do is not combine the two. However, we're going to utilize one line item to express both of these. And what we're going to use is our drawdown slash paydown. So we are paying it down, therefore it is a negative balance. Ba-boom. Command right, and there we have it. Now, we'll give this a note here. Give this a note here. Give this a 0. Oh. Check these. And then let's also reset our circuit breaker real quick. On, off, we're still looking good. Just want to make sure we don't ref out, break the model along the way, and create another circular reference. Now from there, what we want to do is also go to our balance sheet and express this. So long-term debt, net of current maturities, we may have to play around with this later, right, because this is our amortization. For our long-term debt, net of current maturities, we go to here, go if CB equals no, on 0, if not, go to our end of period balance, command right, and it's already in green. Our revolving line of credit, we're going to use the end of period as well. So what we'll do is same if CB equals on, give it a 0, if not, come here, end of period balance. Excellent. Now we see that this is, revolving line of credit is now a drawdown of 110, or we have 110 on our balance sheet. And we now have, under our payment under line of credit, we have an inflow of $110 million coming in. Hoping this is making sense so far. Now when we get to the quarters, what we want to do is we already have one quarter done, right? So what we want to do is we're going to take, in parentheses, this, or the fiscal year, subtract the Q1, and divide by 3. I'm going to fix these so it works in a proper manner. Excellent, and then what I'm going to do here is something very similar where I am going to take the same equation actually, and just, since I fixed it, we can do this as well. Excellent. So now we have this number here, right? We see this difference. We need to account for it on our balance sheet as well. So how we're going to do this is, let's take our long-term debt, and then we're going to take, let's see, an outflow of this much every single quarter. So we're going to take this, sorry, 1 second here. What we're going to do is take, don't want to go backwards here. We're going to take this number here, our beginning of period, and then what we're going to do is subtract our quarterly amount from our balance sheet. So we're going to take from our working capital here, or for our debt schedule, we're going to take this amount and then add, because it's a negative, this amount here. Excellent. And then for here, we're actually going to take this number, the previous quarter, and then add this, and then we'll just write. Excellent. And then from there, what we're going to do is we need to touch on a revolver now. So for a revolver, what we're going to do is we're going to take our beginning of period. So we'll have to use an if function too for a circuit breaker, and I'll have to go back to our long-term debt and do that as well. So if that's my bad, but we'll just go back and edit that in a second. So if CB equals on, because we are referencing it back again, give me a 0, and if it's not, this is going to be kind of an equation here. We're going to take a beginning of period and then add the sum of our cash flow statement of these two here. And that should give me this number. And now what we're going to do is do something where, we did something very similar to this, right? We're going to take our previous number and then add how much in the quarter, and bam. So these will also all get that treatment. And let's go edit this again just to make sure we don't, create any form of circular references. If CB excellent. So let's make sure nothing's completely broken here. Seemingly good. Let's go back to our circuit breaker, turn it on and off. And we're looking good so far. We're making progress. And then what I'm going to do here is do the same thing just so it's consistent. So if if CB Excellent. Let's do it to these quickly. So now we have a reference is good. Let's do it to these. One last time. Don't know why it's not giving me that. Excellent. Now let's go back to our debt waterfall. On, off, and looks like we are good to go here. So one thing that I noticed is when we're dealing with the cash sweep, I made a mistake earlier, so we have to amend it. When looking at the cash sweep, I realized that I wasn't taking into account the cash sweep. So at the moment, if I do this as a 1, these numbers still stay. Just the interest, it doesn't take into account the payment of the ability to pay down early. So what I have to do, and what I should do here, is I'm going to circuit break these, but I'm also going to include the cash sweep. So if the company decides to pay it back early, if the company decides to pay back their term loan early, it'll take it into account and flow directly through. So what we're going to need to do is I have to take equal, okay, we'll just go back and then we'll just do plus F32. Excellent. Now let's take a look. It's going to value it out here, right, and create an issue. But now we have the ability to come back here, set it back, and we're good to go. So what I'm also going to do here is change the name of my cash sweep button to CS. All right, and from here it is going to be off and on. So I'll do off here, and it's going to display a value. Delete that. Give us the if CS equals on, give me 0, or give me that number, and then if, and then if it's false, I'm going to do 0. Control right, and we're back. We'll take this, put that there. Delete that. Boom. Excellent. And then with these, I'm also going to create a button for it. Lists, source, these two. Excellent. Make that white. Now we have both our circuit breaker make this a different color. And ta-da! Now that we have our debt waterfall finished, let's start balancing our statements and our balance sheet itself. Now I don't expect this to balance perfectly the first time, however that's what we're going to be striving for. There may be a little bit of difference because of how we did the debt and the interest itself, but it should be very negligible. Okay, so let's get into our statements here. So at the moment we see we have our check is significantly off, right? So what we need to do is get into these line items and figure out how we're going to connect them. And it's a little bit tricky because we have quarters here and then the fiscal year here. So let's get into it. First of all, this deferred income tax, I'm just going to make this equal to that. It's not too relevant to our thesis. And what we'll have to do is this fiscal year, we're going to have to add it. So keep that in mind, and we'll want our Q4 in fiscal year 24 to end with the same number of cash. So let's see here, amortization of debt issuance costs. We'll sum that there. Loss and gain of disposable assets, we can't really forecast that. So we'll do sum there. Change in fair value of derivatives, again, very difficult to forecast, and I'm not going to create a CISO, which is shareholders' equity, shares outstanding schedule, because it's a little bit complex and there's no need for that. I think it's overkill. Amortization of debt issuances, we'll do the same here. Stock-based compensation, this is something we still have to get to. We will later. Deferred revenue, we'll get into that. We'll get into this as well. Dividend from parent, we'll keep that 0. All these zeroed out. Taxes paid related to bam. Okay, wonderful. Let's go to our balance sheet here. Now the whole idea is we need every single item to link to something, right? So this deferred revenue, what we're gonna have to do here is, so we haven't actually changed it, right? So this would technically be the change here. What we can do is take this number. We'll get to that later. Don't worry about it at the moment. Current operating lease liabilities equal to this. Derivative instruments, same here. Command write that. Current maturities of long-term debt are going to have to get into this here soon as well. So what we're going to do is go to our debt waterfall, and current maturities of long-term debt, right? This is this here, repayments of long-term debt. So we're going to make this negative. For operating lease liabilities, we're going to keep that because it's corresponding to our asset side as well under our, where is it? Maybe I already inputted it here. Oh, under our operating lease right of use assets, we can see it here, right? It's 18. Then we have 15 here plus our 3.7. So that'll net out in itself. Deferred income tax, we're going to keep that straight line. Other liabilities, we have to play around with that. Now let's get into our additional paid in capital. We'll get into that later. Retained earnings, what we're going to do is take this and then add our income from that. So this is Q2 equals this past period plus our net income. Excellent. Control right. We need to change this to that. This number's a little bit off, so we have to get into figure out why that is. Non-controlling interest, straight line. And additional paid in capital is going to be our big one here. So if we kept it straight, which we have to get into later, if we kept it straight, we can see that we are 26,000 off here, right? And what we can see is that's probably attributable to this. Let's fix this. Control right. Then if I just use this, we'd also see the fact that we are 12,000 off here, and that's probably because of our deferred revenue, right? So if we just kept this straight, now we are off. Keep that straight. And now we see that we're off a little bit here, right? We're off 761, 761. And then this constantly increases, so we have to figure out why, right? Why are we not balancing out here? So I'll do this, just other liabilities right now. We have to, again, get into it. But I just want to see where I'm missing, right? So I see 316 in our quarters, right? It's consistent, therefore it's one line item or one or two line items that are doing this, but it's consistent. And then I see this is constantly changing, which is a little bit odd. So that means something isn't linked right. So let's get into this here. We'll have to get into our stock-based compensation and figure out why this is off, and project this out even, probably as a percentage of revenue or cost of SG&A, percentage of SG&A. Deferred revenue, this is going to be 0. And then we're going to see no change, or we're going to see this linked later. Alrighty. So I think there's something going on in this balance sheet that's a little bit wrong here. I'm not sure, but we'll find out. So let's take a look at the formulas. Control squiggly line. I'm not sure what we call it. Let's figure out where we went wrong. Maybe it's in our working capital. Or possibly our expenses build. Good, that should be black because that's a sum of the quarters. That's a sum of the quarters. Sum of the quarters, good. Sum of the quarters should be black. This is seemingly all right. So now on the balance sheet, we see that we're just gonna, make sure things are okay here, right? So some of that, yep, that works. That works. Okay, so all of those are properly linked. So right now I'm just checking to see if things work. I'm a little bit confused, to be honest with you here, on what's not exactly balancing at the moment. And why we're seeing such a large difference. I think we need to go back to our debt waterfall off. Let's go back to our balance sheet. 316, and this is changing. I'm not sure why this is changing. With that being said, I have a little method that we can utilize to figure out what line items are working and what line items are not. So what I like to do is do Alt-WN, so it gives us a new window here. And whole idea here is this is the same window, or this is the same model. It just allows me to have another window that is also interactive. I'm not going to use this as an editing tool, but what I can do is, and we can tell it's different because we have the lines here, right? Everything looks a little bit different. What I can do is I can watch my balance down here while I go through my different statements, right? And what I'm going to do is I'm going to delete all of cost of goods sold here briefly. It does not change my check, right? Therefore, it's linked correctly. Does not change my check. Doesn't change. Kind of see where this is going. And this allows me to see where things are being linked correctly and possibly incorrectly. Now at these, it will change it, but we'll see if it changes it the right amount. If I delete that, we're still seeing differences. It's not that. Still seeing differences. Let's see inventories. Not inventories, prepaid expenses. It's a percentage, it doesn't have this rollover, therefore that's why nothing changed. Other assets. Nope. Accrued expenses. Nope. Accrued compensation doesn't change anything. Doesn't change anything. So at this point, we have to think about what is changing and causing this $7,000 difference here. So we notice that our assets are less than our liabilities. I'm not exactly sure why at the moment. So we got rid of the split screen, now coming back, we can see that our cash is different. It's different by 10,000 or 10.15 million. So we're looking to fulfill something like that. And yes, this has a difference as well. So what I'm thinking is we're not flowing through something correctly on the cash flow statement of around 10 million, but it's also possible that something is going on. Example, right? I didn't take this into account. Now let's see what we got. Now our cash is the same. So that was our issue with our cash. Now when I'm looking at this, I can see that my long-term debt, these two are different. This number and this number, they should be the same on my balance sheet because my Q4 is the same date, right? 7/31/24, it's the same date, therefore they should be the same. but this is off. So let's take the difference of the two and see if this is the issue. Well, we will have to fix this regardless. 2,500. So we are close, and this could be a serious issue for us at the moment. We will have to go back and change this. This is fine, this is fine. This is also 13,000 off. So I have to figure out why that is happening. So I'll highlight this. I'll highlight this. And those, it seems as if are two biggest issues. And we can also, if you want to check it quicker, right, you can see that this 401 is not equivalent to the 399. Therefore, I know this is the issue here, right? I see that my total assets, these numbers are the same. Therefore, there shouldn't be an issue there. My total current liabilities, they're identical. But these are different. So that's where my issue kind of derives from. You can also see that this is different as well. So, well, now it's, because of our retained earnings as well as our long-term debt net of current maturities that we have to get into this. So, when looking at why our retained earnings is off, we notice that we have two line items here, right? Our non-controlling interest as well as our retained earnings. So, I linked this to U17 on the income statement. So, let's go to U17. And notice that I'm doing it net income, right? I forgot to net income attributable to Duckhorn. So what I really want to do is this is 19, right? And then our non-controlling interest, that'll be growing as well with this net income attributable to non-controlling interest. So this retained earnings, I actually want to make it U19. Come here, 19. Right, now we see that this is the same. However, we haven't actually inputted this as well. So what we're going to do is take this number and we're going to subtract this number here. Control right. And here for a non-controlling interest, we want to do the same thing, however it's corresponding to the yearly. So this is going to be referenced back to my fiscal year 23. So now these are the same. Perfect. We see that these are identical here, so we need to figure out why the 316,000 is off. And then we also see a difference in these numbers here in our fiscal years of roughly about 2.8 million. And then it scales as we go. So I'm pretty sure it's attributable to this here. Right? So if I should do this lower. This minus this, right? And then I do this minus this, we have 316. So we see there's a significant difference here of 2,500. It's a round number, so I'm curious, it being 2.5, it's probably going to be some sort of input, some hard-coded number that I've screwed up or that I miscalculated. This 316 should flow throughout the entire thing as a singular, maybe a plug if we want to incorporate that, because $316,000 isn't really that big of a deal, right? That can be equivalent to some small one-off charge, right? Of, possibly a loss or gain of disposal of assets. So this is what we're looking at here as the main difference. Now we have to go and fix it. So now that I see this 2.5 million, what I want to do is search for that 2.5 million. So not there. $2.5. Oh, bam. There it is. This cell right here. Here we go. So what I forgot to account for was this number. So now that I know that, I have to edit this formula here. So it is possible that I want to just take this completely out. But I'm not exactly sure. So now I see that there's this difference here, and I am accounting for it in this total number, but I don't think I'm accounting for it on my balance sheet. So what I want to do is take that, and then I'm going to add this number from my cash flow statement. Sorry, subtract. And now we are done. With this at least. So see, 316 is the difference here. We will have to figure out why exactly, but it's pretty much negligible. So now I'm looking at, we have some sort of difference here and here, and this is constantly decaying. So what I'm going to do is take this, subtract that from that, and they get 342. Now I do recall there being a 342 somewhere, but I'll Command F it. There's a 342. So what I didn't do is I didn't account for this, right? I didn't account for this throughout the rest of my model. So now if we go back, and this is something that I want to keep rather straight, this is only this number because I'm summing it. I'm summing it across. And this shouldn't, these over here, I'm not accounting for it in the future, because it's pretty much negligible, right? So now if I go here, my balance sheet is similar across. But I still see there's a difference in this number, and what I realize, I take this minus this and I get the same number, $2.5 million. So I also realize I'm not accounting for this in the entirety of my model here. I'm not accounting for, in this long-term debt, I'm not accounting for this change up front in the rest of my model. So let's fix that. So now looking at this overall, we realize that we're short $2.5 million. But the issue is, these aren't exactly the same. And when we base our entire model off of, or our debt model slash waterfall, this is what's missing, because we're modeling off of our years and backing into our quarters. However, our quarters are accounting for our Q1, but not our years. So how do we go about that? So let's go back to our debt waterfall and realize that we should get a different number here. Our end of period balance is already taking into account this 2.5. However, it's not actually correct here. So what I should be doing, go back to this balance sheet. Excellent. So we now see that we have 29 here. Very close. However, we still have an issue here in this quarters. So how we're going to do that is we're going to mitigate it by taking into account our cash flows from this year here. And here we go. We also realize that we already accounted for it in here, so we have to get rid of that. And ba-bam, 29. We are missing 29. $29,000 in a company that is generating about 70 million per year. That's okay for me. That does the trick. So now that we finished that, let's clean up a few things that we wanted to touch on earlier, such as our other current liabilities. So right now we have this straight line, which is fine. However, what we really should do is we should model this out. However, we see that there's a difference in other current and non-current liabilities. They combine into one. So what we're going to have to do here is come to our working capital, and we see that this is looking at our other current and non-current liabilities. However, we want to try to break them up in the best way possible. So what we're going to do is we're going to do other current liabilities, then other liabilities. Let's see what we denoted. We'll do the same here and go with revenue. We have to do an insert a row here because we need to do beginning of period, change. Yeah, so we can just copy this from up here. Excellent. Now, beginning of period, other liabilities. We'll do end of period here. Let's go to our balance sheet. I believe it was 2019. That's 2019. Excellent. Goes this. All right, let's just check that reference. Excellent. All right. That'll work there. That'll work there. So that's interesting, that didn't change. Let me check I'm referencing the right thing. Q1 24, didn't change. All right. Now let's do the same, here, with our other current liabilities. So again, we have to alter this. insert a row. Not going to get that, so we're going to get this. End of period for 2019. Copy that right. Excellent. It's just referencing that so I can copy over. Boom. That's fine. Equal this. That. Now we have a full year built out. C51. Sorry. Excellent. So on a year, it seems like it's making up roughly about 0.3. Ta-da. Command right. And here, this times what am I doing here? Q2. Yep. This times revenue. Perfect. We'll keep this 0.3 throughout. This seems a little bit off here, not sure why. Oh, I didn't convert it from days. That's alright, I'll just do. See what we got here. 3, 3, 4. Seems like it's rather high here. I don't mind that, that works for me. Perfect. Okay, so now we have this. Now let's get into our other liabilities. Copy this up here. Enter another row up here. We can literally copy this, which is excellent. Copy this, boom. We can fix this. And then we come down here and just multiply this by revenue. Peter's a little slow here, not sure why. Change this. And we see very little change here. Keep this going here. And this as well. Make sure we didn't screw up any of the formulas. Now this is rather arbitrary, it didn't affect things too much, however just wanted to make sure we fully build it out. So let's now enter these in. We realize that other liabilities, this will be our end of period. So let's go to our other liabilities in our balance sheets. Let's go all the way over. Now let's balance this out. Cash flow statement. I'm going to get to this in a second because it's a combination of both, so we have to add both together into this one line. Other current liabilities, end of period. Excellent, I'll turn these both. Now we see, this is kind of altering things, so let's get into it. So a change, working capital here plus this. Now let's check to see if we got it the right direction. Yes, we did. Perfect. So now we're back in balanced. We did our other liabilities here. and we'll get to formatting here later. Just want to make sure everything's good. Sweet. Now deferred revenue, we'll get into this another time. I don't find it too material, so we're just going to do a 0 here. And that's okay, not a big deal. Anything else that we need to go over? Yes, we need to go over stock-based compensation. So with our stock-based compensation, what we want to do is go to our working capital in DNA. I'm going to insert a few lines here. Copy this formatting. And do stock-based compensation, do equals that. As a percentage of revenue, we can literally just copy this line because it is fixed. And then stock-based compensation, cash flow statement, 2019. So we see as a percentage of revenue, just to make sure this is exactly referring to it correctly. Yep, perfect. As a percentage of revenue, it tends to be around 1%. So we'll just keep that going. Perfect. Do this. This times our revenue. Sum these up. Boom, boom. Oh, no X there. All right, so that's our stock-based compensation. Perfect. Now let's go back and insert it into our cash flow statement. So this is easy. Because it's stock-based compensation, we did it based off of the cash flow statement here. What we can do is quite literally just enter this in. However, we're going to have to engineer it on the balance sheet. Same thing, same idea, just backwards. And because this is a non-cash expense, we're using stock to compensate employees. It is an addition of cash. Oh, there we go. Let's go to our balance sheet. Now what we have to realize is we don't see stock-based compensation in here at all, right? It's not under assets, it's not under liabilities. You have to remember what it is, stock-based compensation. So we should be able to find it in our shareholders' equity. So what we'll do is we'll account for this in our additional paid-in capital. So put a note over here stating that, and this is how it is done. Additional paid-in capital includes SBC. So what we want to do is rather simple. This plus this. Excellent. So now we have really accounted for everything. So now what we want to do is go through our formatting, see if we have everything correctly. So we see that what I'm actually going to do here, we'll keep it that way. What I'm going to do wonderful, these are all green. Those are black. These should all be green. As well as this. And that seems correct. Let's do the same on our cash flow statement. Those are constants, we'll have to roll them out. Make that green. These green as well. And that seems good. Get rid of all these. Now what I'm going to do, get all of my constants here. F5. Special constants. Highlight those. And make them all blue. Perfect. Now it is time to get into our DCF, or our valuation. So moving on to our valuation, we'll do a DCF in a second, but there's some things we need to do here, such as get our EBITDA and adjusted EBITDA here. So purchase accounting adjustments, we can't really equate for that. So we're just come in, write this, and we have to redo the formatting here. Same thing here. However, the big boy is going to be our stock-based compensation. And we can account for this, right? We saw it in our cash flow statements. Let's go back to our working cap. Same idea here. All right. Excellent. Let me just change the formatting here. I'll do it for really all of this here, just so we don't have to do it in the future. Perfect. Do this. Fantastic. Operating cash flow. Take all of this and copy that down. Make that green. Now we have our EBITDA, our adjusted EBITDA, and our free cash flow. So let's go over to our DCF, which we will build out, and I'll go through everything really. So the whole idea here is we're doing a discounted cash flow. So we are quite literally discounting our future cash flows, and there's a few things I want to note. First, I will state that a discounted cash flow is only one way that we look at things. Companies trade off of multiple different metrics, such as EV/EBITDA, EV free cash flow, EV sales, and we need to take into account all of these things, not just the DCF itself. So let's get into our DCF now that we have all that we need here. So a DCF is a discounted cash flow. The whole idea is we are taking future cash flows in two different stages. One, the cash flows that we've projected out for the last 10 years or 5 to 10 years, and then after that, we're taking the terminal value. And the whole idea is we want to discount these back to present value, divide by the total number of shares outstanding, which gives us our upside, downside to our current share price. And from there, we can sensitize it and get a better idea of maybe if this company is under or overvalued. And from this, we don't want to just use a discounted cash flows because there are so many different methodologies and different things that a stock may trade off of. So oftentimes you'll maybe do a PE ratio, a EV/EBITDA, a EV sales, EV revenue, a EV free cash flow, an EV free cash flow, 2025 free cash flow. So these are all things we want to take into account and understand about the company. We don't want to just use a DCF because oftentimes our model may be spitting out a certain number, but there are so many different factors that go into this, and we may be missing a significant portion of the actual narrative if we just model off of a DCF. So let's get into it. Let's first spit out some of our assumptions, and we'll get into the DCF itself. So I like to have a few things here on my DCF. So one, I want to do my tax rate. From there, I also want to do my discount rate, aka my weighted average cost of capital. And then from there, I want to do my perpetual growth rate, my EV/EBITDA multiple, I'll just do multiple there, the transaction date, and this is all up to you really. You don't need to do this a set way, at least these assumptions. I just like to have all of this listed so when someone is taking a look at the model, they can understand where these numbers are deriving from. Then I'll do the fiscal year end date, the current price, the diluted number of shares outstanding. As well as my debt and long-term liability, sorry. And my cash and cash equivalents. So from here, right, I have kind of everything I really want to play around with. We'll format this. Excellent. And now after that, I want to list my intrinsic value. This seems to be already a little wonky here. Your general there. So here I want to do my enterprise value. Then from here, I'm going to add my cash, subtract my debt. What you can do this all in one step and refer to it as net debt. Subtract my preferred equity. And my, we don't really, it's in this example. We do minority interest slash non-controlling interest, NCI. And then this will give us our equity value, and then we divide this by the total number of shares outstanding, giving us our equity value per share. Here, copy this, and then fantastic. Underneath this, you want to do your terminal value, or your terminal value. So how you get your terminal value is your perpetual growth and your multiple valuation. So the whole idea here is this terminal value is going to be a function of these two averages. Oftentimes at your banks, they'll just utilize your multiple valuation. We'll find some sort of midpoint between these two and work from there. Oh, and then an average, of course. Sweet. Now let's get into building out our actual DCF. So with our DCF, there's many ways to tackle this. In some instances, people will take your sales or your EBIT and then go all the way down the list to your net operating profit after tax. Or you can just bring in your EBITDA or adjusted EBITDA and then go off of that. So what I'm going to be doing here is probably utilizing EBITDA or adjusted EBITDA and then deriving from there, building out my free cash flow. First, before we do that, right, let's get into here, building this out. So the first thing is going to be our entry. Then we have our fiscal years, right, so 2025. Excellent. Oh God. Excellent. And then from there, I want to do the date. I think this is formatted already for some reason. Not sure why. Okay. Then I want to do the date, the year fraction, which we'll get into in a second. And then what I'm going to do is take my adjusted EBITDA and then also get into my CapEx and my changes in net working capital. Excellent. And then that'll give me my free cash flow. Under that, it'll give me my transaction free cash flow. Alrighty, I'm going to turn these italicized. And let's get into our assumptions as well here. So, our tax rate, well, this is rather straightforward, right? What we're going to use is equals, I believe we have it built out on our expenses build. Yes, our tax rate, we straight lined it just because it seems pretty, pretty stable here. I believe we took an average. We can note it there. I took a little note there, so we'll all format this as well. Discount rate is interesting. So discount rate is also known as our WACC, our weighted average cost of capital, which derives from, there's many different ways to go about it, but our cost of equity and our cost of debt, and you multiply the cost of equity by the percentage of equity, and the cost of debt by the percentage of debt, and this gives us our weighted average cost of capital, which takes into account what we're paying for our debt, equity, and how much risk we're taking on for this name in itself above the overall market. So from here, you can calculate this out, and your senior analyst will probably be able to show you how to do that, and we can go over on another video later on this as well. However, in this case, what I'll be doing is utilizing equity research that I have been looking at from JP Morgan as well as Barclays to come up with a consensus number of, I believe it was roughly about 9.5%. Now, perpetual growth rate, this is basically saying that we're going to be applying this to, we're going to be applying this to our terminal value, our stage 2 cash flows. So our stage 1 cash flows is what we projected out here, right? Our stage 1 cash flows is what we projected out. And then we also have our stage 2 cash flows, which is basically known as our terminal value. And the terminal value is stating that this company isn't going to completely just go out of business and fall off of the face of the earth. It's going to continue to exist. So because it is so far away, it's really hard to get a really good idea of the cash flows, 15, 20 years out, right? So the whole idea is what we're going to do is tack on a perpetual growth rate for this company to either be growing along the geographical economy or the industry itself. So in this case, what we'll be doing is just doing 2.5%. And then for our EBITDA multiple, what we're going to be doing here is oftentimes utilizing our basket of comps as well as taking a stance on if we are going to be seeing some sort of multiple re-rate, expansion, compression, etc. We are going to be trying to look at the basket of comps around it and figure out if it is justly valued within its space. If we believe that they're going to see significant more growth, there's significant more room for this company to eat up more of the overall wallet. This will all go into your EV/EBITDA if they're better positioned than fellow competitors, etc. You get the idea, and we'll use a basket of comps to usually derive this, as well as equity research to get a better ballpark of this. With that being said, with Napa itself, it's currently trading at 10.6 EV/EBITDA. Last year, around, I believe, mid-year in 2023, it was trading around 14.6, 14.5, 14.6, and then in 2021, when it first IPO'd, it was trading more around 31x. So we could see back in 2021, it was extremely or richly valued. With that being said, I think without being too biased here, we can confidently say maybe a 14x, and then we can adjust it later as well. Transaction date, so we'll just use today, and then close parentheses, we'll just return today's date and constantly update. Fiscal year end date, it will be what we've constantly seen, right? So mid-year. So we'll do date, and then 2024, comma 7, comma 31, returns that. Now current price is interesting. What we're going to do actually is use a out of worksheet link to generate this. So I'm going to type the ticker over here, and then what I'll be doing is going to data here, and then you see stocks, right? So it's going to convert this cell into a stock that links to, I believe, Google. I guess it'd be Refinitiv. So select that, and now I have the ability to reference this cell, and then I do a period, and then it gives me plenty of options of what I can constantly update. It's basically an API. In this case, I'll just use price, where it's at 902. The diluted number of shares outstanding, we're going to be using the most recent period. So we see the weighted average shares of common stock of diluted is that number there, reference that. Let's do our debt now. Excellent, and then cash as well. And when looking at what cash and cash equivalents is, oftentimes with other companies you'll have a second line right under cash because your balance sheet is in order of most liquid to least liquid, and the whole idea of a cash equivalent is it is a security that is redeemable sub 12 months, so it can be in a money market fund, overall market securities that allow a company to generate revenue or interest revenue on their securities or on their cash instead of just leaving it there and letting it erode via inflation. So you get the current cash, and from there we have our assumptions. Let's edit these a little bit here, just in terms of formatting. Fantastic. Make this green. Make these both blue, as well as this. These are cool. Now this is our first out of workbook link. We use purple 131 0131 linked, and then both balance sheet as well. Perfect. Now let's get into building the DCF itself. Diving right in, our date, our entry date, so what date we are entering the transaction or initiating coverage of this, is referring here. And then for fiscal year 2025, it begins in July of 2025, but it ends, basically what we're going to do is EO month, date, or sorry, we'll just do EO month, fiscal year, and then 12 months. Perfect, and then we'll reference this EO month here, so end of month. It just makes things simpler, and then 12 months from there. Then perfect. And then for our year fraction, the whole idea here is because we are entering this position on 117 opposed to the 7/31, 2023, we can't capture or discount stage 1 cash flows that have already occurred. So we're going to be utilizing a percentage of the year under transaction free cash flow. So what we're going to do here is year frac, so year fraction, and then our start date is going to be our entry, and then our end date is going to be our fiscal year end date. So 54%. Now moving forward, we'll continue to do this year frac with the start date being the fiscal year end, and then that being our end date. That's going to look a little wonky right now, but that's going to be H6 or G6, sorry. Command right, wonderful. And then exit is going to be this date as well. Fantastic. Alrighty, now let's get into our actual numbers here. So adjusted EBITDA. Oh, sorry. Just EBITDA. It's going to come from our income statement. Fiscal year. Adjusted EBITDA. So this includes our stock-based compensation. But boom. Control right. And then what we're going to do is we'll be subtracting our CapEx and our changes in net working capital. So our CapEx, this number here, make it negative. Changes in net working capital, so we've already calculated this. Right, so you see our changes in net working capital right here, right? Boom. And then we get to our free cash flow. So let's quickly format all of this. Excellent. Not sure why it's laggy, but we'll deal with that in a second. So what we're going to do here is take our adjusted EBITDA, subtract our CapEx, and add our changes in net working capital. And that gives us our free cash flow. Fantastic. And then transaction free cash flow, we're going to take this and multiply it by the year fraction. Excellent. Oh, what just happened? Excellent, so now we have all of that. And let me fix my laggy computer. Alright, I think we're good. So now, this is all of our stage 1 cash flows, right? But to get our real intrinsic valuation, what we need to do is include our stage 2, aka our our terminal growth. So this is going to have the same date because we still want to NPV it, so bring back to net present value it. However, we now need to fill out our terminal value. So how we're going to do this is multiply, to get our perpetual growth, we're going to take our last year of free cash flow, then multiply it by 1 plus our perpetual growth rate, and divide this by our discount rate minus our perpetual. And that should give us a number there. And our multiple valuation is rather straightforward. We're going to take the same last year free cash flow and multiply it by our EV/EBITDA. We see that these are somewhat similar, which is a good sign. And we'll do average of both of these. Format these. Excellent. Now, from here, what we want to do is take this here, and then we're going to put our terminal value here. So you can do exit/TV. Now comes the fun part. So now that we have our stage 1 as well as stage 2 cash flows, we need to discount it back to present value. So what we use here is what we refer to as XNPV. So that's our formula here. So XNPV, our rate. So this is our discount rate. What are we discounting the cash flows by? This is our WACC. Our values are all of our transaction free cash flows here, and the dates are here. Fantastic. So that is our enterprise value. However, this is taking into account the entire capital structure, including debt, minority interests, preferred equity. We only want what is available to our equity holders so we can get down to a price per share. So from here, we're going to take our cash, our debt, our minority interest. I don't think I actually brought this in, but that's okay in this case. And from here, this should give us our equity value. So we do this is we are going to take our enterprise value, then we're going to add our cash, subtract our debt, subtract our minority interest, and this gives us our equity value. Excellent. So now let's do equity value per share. Right? Pretty straightforward, I hope. Oh, what did I do here? Excellent. So I'm going to take my equity value and then divide it by the diluted number of shares outstanding. However, I believe that this is not transformed into places, so I think that's it. Oh, not that. And there's our equity value per share based off of our current valuation. this is what we've been looking for. This is what we do this for, to get our equity value per share. Now we need to get into how we're going to sensitize this and get a better idea of how markets may price this in the future based off of sensitivity analysis of your weighted average cost of capital and our EV/EBITDA multiple. So now I want to create a sensitivity table. So this is what happens if my weighted average cost of capital is 11%, right? Or 10.5%, and our multiple is instead 12x instead of 14x. So it gives us a better sense of probable outcomes of the future based off of market pricing. So what I want to do is create a table, and I'll walk us through this here. So weighted average cost of capital here, and then EV/EBITDA. Excellent. Now my base WACC is 9.5%. But with data tables, I've found out, or this at least works for me, that you can't actually reference this cell. You can't reference 9.5. You have to type it in manually. So I'll put 9.5 here, right? And then from here, I'll do this plus 0.005. There we go. And on the other side, I'll do minus 0.005. And that gives us that number. Now if you're a little bit confused here, not a big deal, we'll go over it again in a second, and I think it'll make a whole lot more sense. Now, I want to do EV/EBITDA. So my midpoint, what I'm expecting is 14x. And remember, data tables are finicky, so we're not going to actually reference a cell, we're going to type it in. So 14x. Now, what is going to happen is I'll take 14x minus 1. What if it's at 13x? What if it's at 12x? Plus 1, command right, and I'm going to edit the formatting here. There we go. And there we have it. So where this comes into play is I now want, and this needs to be in this corner here. I'll highlight it for references now. So in this corner, what we want to do is input whatever we want to be sensitized. So in this case, it's our equity value per share. So I'm going to put this number here. Now, what I want to do is create a table that expresses the values that occur. So if it is at 12x and trading at 12x EV/EBITDA and WACC is more like 10.5, then it'll give me this share price. If I am trading, or this Napa is trading at 16x and WACC is 8.5, then it'll give me a certain share price. So this gives us a better idea of future possible outcomes. Now, how are we going to go about this? What we're going to do is we're going to go to data and then a what if analysis and data table. So now what we want to do is reference our WACC as well as our EV/EBITDA. Now for our row input, we're going to put our EV/EBITDA. For our column input, we're going to put our discount rate. Press it and ba-bam. Turn these into this. We'll actually do a currency here. Center those there. Now we also want to make these look better, right? So what we're going to do is a conditional formatting. So Alt-HL, color scales, and I like this first one, so you can see here, red, and then green, 13.09. Excellent. bold these, bold this, and preferably I don't want to see this, right? Oh, my bad. I don't want to see this, so I'm just going to make this white. And there is our sensitivity table. What I also like to do is make a sensitivity table for percentages. So before we do that, we have to create a upside downside. So upside downside, so current share price and then price target. So our current share price is going to be this number here. Our price target, the midpoint there. And then what we're going to do is take the difference between those two. Excellent. Now we have this number here. We're going to do the same thing. Very inefficient here, but that's okay. Already have this equal this number here, and then we're going to do the same thing as before. Row input cell, column input cell, oh bam. Excellent. I actually want to move this one up. Darn it. There we go. So now what we have are our two sensitivity tables, so we can get a better idea of what would happen, what's currently going on with the name itself. Now what I want to do is go beyond this and into EPS as well as other metrics that are extremely important. So we'll come over here and then we'll just do we'll figure that out. But what we're going to do is we'll just do metrics. We'll change it later. Metrics here. So what I'm going to do here is my EBITDA, my free cash flow, and then my per share metrics down here. So I'm going to do I can't spell. There we go. EBITDA per share, free cash flow per share. Then earnings per share. So the whole idea here is there's more to it than just the DCF itself. Oh, not sure I have this down here. I'll get rid of it. There's more to it than just the DCF itself. Oftentimes when you're trading quarters, we want to care about, a big metric is your earnings per share, as well as EBITDA per share, free cash flow per share. So we should definitely model it out. And in terms of quarters, years, what we're going to do is we're going to do by quarters up here. And then we'll just copy the format in. Excellent. And now we can get into it. So EBITDA, here we go, free cash flow. Then what I also want to do is adjusted EBITDA. Super laggy. We'll do revenue as well. Or sorry, we'll do net income. Excellent. Then per share metrics, it'll be pretty straightforward. format this, divided by delivered number of shares outstanding. I'll fix that so you can copy it across. Divided by, I believe it's 1,000. Yep. Do that correctly? No, I didn't. Sorry about that. I'm going to put EPS on the top here. And then what I can do is that down there, control write it. And format it. Excellent. That's fantastic. I actually don't like that format. I like currency better, or accounting better. There we go. Fantastic. Fantastic. So there we have it, folks. So we have our earnings per share. We have our metrics themselves. I think that should do it. Now, what I also like to incorporate oftentimes is a valuation methodology. So what I'll do is nope, stop that. Valuation method, right? I'll have my DCF, my EV, EV free cash flow, maybe like future, so 2025 free cash flow, and then EV 2025 revenue. So from here, what I'm going to be doing is understanding the multiple, what share price may occur, as well as the upside, downside, and midpoint. So right here, let me see. Actually, if I insert one row here, unfortunately. Yep, okay. So to do this, what we're going to have to do is we're going to take say our multiple. Oh, I just turned off my PC. Sorry. Our multiple, our share price, upside downside, as well as our midpoint. Center cross selection, hold it, and then excellent. So our DCF, our low, our low multiple is this. High multiple is this. EV free cash flow, we're going to have to go over this here soon. I'm going to have to comb through ER quickly to get a better sense of it. Share price is rather simple. So on the low side, that number there. And boom, bam. So we're going to have to go into these here in a second. And what we're also going to have to do is later build out some of our build-based bowl. We'll do this after we finish this. Oh, forgot to enter my midpoint, so here I'll do price. Here I'll do return. So price, midpoint, do this. Add routine these two. And then return, do this. Minus this, divided by, sorry, I got a little bit distracted there. And bam. So now we have a better idea of these, and then we're going to get into our EV free cash flow, EV revenue here soon as well. And these are forward estimates, right? So the whole idea is this is understanding of, oh, you know, this is what I believe 2025 free cash flow is going to be, right? And from there, it'll give me, you know, people are going to be sitting based off of this. Your EV free cash flow will be a certain X. So the whole idea is this will be kind of deriving value off of a certain multiple. So these are the quick and dirties, and oftentimes what things are valued off of as well, and we have to take some sort of aggregate of them to get a better idea of how the stock or how the name trades. Last thing I'm going to do is come over here and change all of my references. And I think it does it. Perfect. So that's our DCF. We'll come back to it after we start linking things, but I'm hoping that helped clear up the point or the purpose. So as a quick summary, how we go about it is we have our stage 1 cash flows, which we've projected out, and our stage 2 cash flows, which is our terminal value. How we get our terminal value is we use a blend of our perpetual growth methodology and our multiple valuation. Perpetual growth, the equation is the last year of your free cash flow times 1 plus the perpetual growth rate divided by the discount rate minus the perpetual growth rate. The multiple valuation is simple. You take the last year of your free cash flow and multiply it by your expected multiple. Take the average of those, and this gives you your terminal value. So here this represents stage 1 and stage 2 cash flows. From there we want to bring it back to present value. So what we do is use the XNPV function. What we do, the first thing is take the rate, which is our WACC, and then we take all of our free cash flows, or transaction free cash flows, so adjusted for year fraction. And then we also, last input is your date. And remember that your date of your terminal value is going to be the same as the last year of your projected cash flows. From there, you want to turn your enterprise value into equity value, because this is giving you the entire cap stack valuation of the company. So we take our cash, our debt, minority interest to get this. So how we do this is enterprise value, add your cash, subtract your debt, and then subtract your minority interest or non-controlling interest, and this gives you your equity value. After that, what we want to do is take our equity value and divide by the total number of diluted shares outstanding, and oftentimes you have to do some sort of conversion, so in this case it's divide by 1,000. From there, you have an idea of your current share price, right, which you pulled from using the data stock and referencing that cell, and then your price target. We've changed this. And then your price target, and from here you just find the difference or find the change, percent change, and this is your upside downside. After that, what you want to do is create your sensitivity tables, and you want to remember that these all have to be hard-coded, or the main one has to be hard-coded, and then you can play off of it. And in this cell right here is the equity value per share, or whatever you want it to reference. From there, what you do is, I'll just do it, you go to data, you go to data, what if analysis, table, in your row input cell, you use your row, right, so your EV/EBITDA right here, your column input cell, you use your discount rate, and it spits out this number. Conditional format it to color scales, well, bam. Do the same thing for your percent change. You're just referencing your upside or downside opposed to your equity value per share. And there you have it. All right, now that we've finished our DCF, what we want to do is create our different cases. So we have our different cases, however, it's not referenced to a singular button at the moment. And this is where things get a little bit tricky, and I'll try to break it down as much as possible. A few notes, I just moved things around a little bit. Bit all white. Make it all blue. Let's make this some sort of gray. Right, so now things are a little bit easier to navigate, but let's get back to the whole idea of trying to create a singular button. So what I like to do is have my main toggle button that dictates my entire model on my cover sheet. We'll build out this cover sheet later on, but I like to have one case button. So, case button. And we'll highlight this because it'll be right below it momentarily. But this is the cell we want to reference. Now, let's get into what exactly we're trying to do. So the whole idea is we have all of the different cases that we can toggle individually. However, what we don't have is one button. So I don't want to go through every single one of these things and have to toggle to change my assumptions, right? I have my expenses build, my revenue build. These are all different things that I just want to press one button and it be able to give me a certain outcome. And I like to reference it back to the cover sheet. So what we want to do is create a scenario analysis. We're going to be using index match yet again, and we're going to be index matching in this cell here. We're going to have to do it for every single one of these cells, so we want to make this equation copy pastable so it moves along instead of having to do it however many different toggles you have at once. Okay, so the whole idea is we want to create a scenario analysis. And what we're going to be doing is creating an index of all of the possible outcomes, all the possible line items, and these will be all of our different scenarios up here. So our base scenarios, right? We have our base, bull, bear. Those are our three main ones. However, what if you want to get a better idea of how the company would do if they had, or if they sold more volume, right? And we want to adjust this to a bull case. Or maybe we want to say they have the ability to charge more for their wine, or they're just simply capturing more of a luxury space, as well as being able to upcharge, and their mix contribution is going to their higher end wines. These are all cases that I want to express. So, for example, I'll do a high volume, and I'll do a high price. And maybe from here, I'll do a low volume and a low price. Low price mix, high price mix. And these are all different scenarios that we will have, or what we want to have be expressed. Now, what we need to do is reference all of our different rows that we're going to be using. So I'm going to be referencing this cell right here. And what's very important to note is the contents need to be identical in terms of the values itself. So what I like to do, just to play it safe, is I will go down. So I need to list every single line item that I want to toggle. I'll go down to my revenue build. I'll copy this. I'll copy this and copy this, and then paste it. Excellent. Now I have the identical version of that, therefore it knows what to reference. Now in my expenses build, I'll do the exact same thing. I'll erase the formatting. Excellent. Now, just a reminder, these are each one of our individual cases that we want to toggle through with our button. These are each of the individual line items that we are referencing to change each one of these individual toggles. So what we'll want to do is create this case button using a list of all of these. So now I have an interactive button. Excellent. So there's my button, and this is referencing these. Now, what I want to do is fill out the possible outcomes. So for volume contribution, for base, this is all going to be base. Make sure there's no space there. So I'm literally just going to go base, bowl, bear. Now for high volume, I want to keep everything, just make it a little bit easier to see here. I want to keep everything base besides the volume itself. So I'll make my volume bowl. For low volume, I'll do bear. And these all stay the same. For high price mix, everything will be base. Everything will be base except the price/mix contribution. So high price mix, bull. You see where this is going. Low price mix, bear. Hoping this is making sense so far. Alrighty. Now, what we want to do is index match this. And this is where things can get a little bit complex. So we have to remember that we are matching all of this information, and we're going to use this whole thing as an index. So what I'm going to do here is first we'll do this. We see that this is not a formula, but we want to make it into a formula. So now we get to a little bit of the tricky part of actually creating the formula. So we can see here that this is just based off of this toggle going to display whatever is the outcome here. But we want to turn this into a formula so it references back to this cover page. So what we're going to do is equals index, and our index is going to be straight off of our cover of all of this. This is what we're looking for. We're going to fix it and move on to our match, our first match. So what we want to do is we want to match the line item with the column of possible line items. So this is what we're looking for here, right? We are looking to find the volume contribution line amongst, we're going to have to fix that as well. We'll get to that after the equation just so it's not as complex. Amongst all of this information. So that's our next match. Comma 0, close the parentheses, comma, one more match. Now what we want to do is match the button. So here lock that with the possible scenarios. Lock that as well. And let's hope this works. Ta-da! There we have it. So if I turn to high volume, right, it should display a bowl for a volume contribution. There we go. So what we want to do is do the same thing to all of our line items here. So next we have our price/mix contribution. Let's go here. What we can probably do is copy this down so we see our index cover is matched. This is not, but its reference is, as well as the button and the reference to the button. So I believe we can copy this and paste it there. And it's referencing price mix contribution. Just making sure here. Excellent. I believe that should work. Let's go take a quick look. Go to our cover. Let's go to bowl. So both should display bowl. Both are displaying bowl. Excellent. Let's go to cost of goods sold. We'll copy the same formula here. And this won't work immediately. So we may have to redo this. So we'll do it again just for purposes, and I'll put this here as well. So you should probably pause the video quickly, and this is the steps. All right. So index, let's go to our array on the cover. All of this. Let's fix it. Now we go to match. Time to match the line item. A little bit more difficult here. Time to match the line item, so our cost of goods sold. To the column of possible line items. I should fix that. Comma, second match, cover, match the button with the rows of scenarios. Here's the button, fix it, comma, the rows of scenarios. There we go. Already so we're currently in bowl. I believe we should be able to copy this. It's giving us a not available, which is a little bit worrisome. Looks like we'll have to retype it again. Nope. Match this with all of this. Match the button with all of this. We'll see if this works. I'm not sure if it will. Nope. We'll have to do it one more time. Practice. It's not a bad thing, so. Back to the cover. Index. Match. Zero. Another match. Button. Button. 0. Excellent. Now what we should have is a toggle that flows through everything. And just for a demonstration, so when you build this out, let's go to DCF. Oh boy. That's a little bit of an issue. I believe we just need to use a circuit breaker. But what we can do is just have this equal this right now. Not a big deal. And we'll want to move the circuit breaker to the first page as well. Alright, so let's see how this moves it. There we go. So folks, that's how we do a scenario analysis index match. And let's build out our cover. So building out our cover here, what we want to do is, this is what I like to do. Beta, industry, and then description, then I have my case button over here. Excellent, so I'll do Napa, select that, make it blend in, ticker, market cap, So what I'm here is I'm just referencing the API to provide me a number. I'll have to divide this. There's plenty of other things you can do with this as well. And then description. Excellent. So let's make this a little bit prettier, right? Oh, didn't get a share price. That's not good. Previous close. Bold, thick, fantastic. Control 1, center cross selection. What we'll probably have to do here is okay, so not need to merge and center those. Lovely. Alrighty, folks. And I don't like to do merging, just because oftentimes it screws with things and makes things very difficult to work with. However, in this case, it works well. Fantastic. And we're looking better already. Okay, so cut this, put it here. Make sure it didn't screw anything up. I honestly want to make this larger. Just so it's very visible, because it's such an instrumental part to the model. And I'll make this highlighted a color. So I also want to bring my circuit breaker to this page. However, we have to realize that my circuit breaker is a button, and I have to move that button without disturbing things. So what I want to do is alter what the button is referencing, because the button will bring its reference along, but just the cell, not the actual button. So Alt-A-V-V, source, delete that. Back to cover, on, off, apply. Take this. Here we go. Now let's see what I have for drop downs. Excellent. So now I'll do case breaker. Just copy this formatting. Just want to make sure I didn't screw anything up here. Alt WN. So I like this function because it allows me to see multiple things at once. So I can go to my debt waterfall and watch while I change this if it actually alters things. Yep, we're looking good. Close out of this, and then I also want to bring my cash sweep to this page as well. So same process. There we go. Command X. Command D. See this toggle. Yep. Love it. So all our toggles work. We now have a much better front page than prior. We are making progress. Alrighty, now one thing I also want to do here is I want to have all my upside downside cases that go along with this. So the actual price of the actual valuation. Upside, downside. Gonna move these. And then from here, I'm gonna do my DCF. And this is just going to equal upside, downside, boom. Jeez. Let's make this 30. I actually don't mind 15. We will center this across. And I think we have it. Let's hide all of this stuff here. There we have it, folks. We're done. So now that we're pretty much done, let's just look things through and do some general formatting. In my opinion, it's extremely necessary to have good formatting in a model. While you're doing it, it doesn't really matter as much. It may help your own organization, but it's necessary when you're trying to turn in a final product. And I know a lot of you guys want to send these pitches to different recruiters and your kind of contacts, and it'll help in your networking calls. And I think when you show them a finished product that is really polished, that's the difference maker, especially if you want to go into something along the lines of banking. What I like to do is put little X's around everything, therefore it's easy to navigate. On this title page, it isn't as relevant. Here I see all of these X's as well. I'll put one up here, put one here, just in between things so I can navigate the page easy. This is good here. Put at the bottom here as well. And let's make this look a little bit better here as well. All right, that looks better. So now we have that done. Research page is good. DCF will do the same thing. Go all the way over here. I also like to have the columns at the end to be size 2. That's a personal thing. This seems good over here. that. Get rid of these. And we should also touch up this here. I'm thinking and hoping this will work. We will see. Oh. Darn it. Fiscal year. X5, S5, that should work. So this all works well. Now what I want to do surprised I didn't catch this earlier. Okay, now what I want to do is the full-on years. I believe I can go back here and get it. Yep, that should work. Excellent. Alright, that's great. Now that'll work. Change that. Sorry, this is a little bit slow here. I'm just trying to make sure I didn't screw anything up. That should just be like that. That doesn't make sense. Yep, refed it. And we go back to our case breaker, on, off. Interesting. It's a little bit worrisome. Seems like everything's working well, so I'm not sure why this is doing this to me. All right. That's fine. Sweet. All right, we're done with that. All the way back up. What we can do here. Just balance it out with 29. Yes, I did use a plug. It's $29,000. It most likely occurred from my revolving line of credit being a different interest rate because I'm using a different SOFR, taking into account both years. So that's probably the main issue, but $29,000 for a company that generates 70 million is not too bad and works for me. Good to go there. Back to the top. This is not exciting stuff, I'm sorry. Oh. Excellent. It's getting late and I'm starting to lose it a little bit here. Get rid of this. Debt stacks or debt waterfall is looking good. Oh, this isn't the prettiest, to be honest with you. Leave that there. Is that not centered? No. And that's it. So 85% zoom on everything. That's just a personal thing, but everything should be presentable. Every single piece of the model should be seen as, every single piece of the model should be presentable. So I want, when I'm going to save this down, it saves in its last position. So what I'm going to do is make sure that all of my files are at 85% zoom on top left. Right up there. Top left. So when the person opens the file, it's automatically opening to the cover and the top left right here. So I hope that was helpful. If you have any questions, feel free to text, email, whatever. More than happy to answer. A few final touches here. What I want to do here is create a conditional formatting. So cells that only contain greater than 0.00001. Set the formatting to a fill of this color. Okay. Undo. Only contain less than negative 0.00001. Format. give me a red. That's quite the red. Knock it down a little bit. That's absurd. Great. Excellent. I'm going to copy this, bring it down to here. Where's the conditional formatting? There we go. Oh my god. A few final touches here. What I want to do is conditional format this. So everything that's greater than 0.00001, format, give me a nice green. Excellent, then I'll do it again. Less than negative 0.00001, format. Let's go with the red. More colors. That'll work. Okay, copy this. Let's go back to the DCF. Refed it, it's not good, so I'll just do it here again. Cell value greater than 0.00001, format, give me that green again. I'll do it one more time here. I know it's not the same color, but that's okay right now. It's 4 a.m. Okay. In terms of formatting up here, there may be a few issues. For example, it's not pretty. Much rather prefer that. Sweet. Besides that, I think we're good to go. Well, thank you guys so much for watching. I hope it was informational, useful. If you have any questions, I am more than happy to answer them. And that'll do it.